Welcome to the ACE Archive. If you look closely at the mechanics of any business enterprise, you'll find a single, essential component keeping the whole thing alive. Finance is the lifeblood of the operation, but that lifeblood is incredibly vulnerable. A business requires cash flow at every stage, for starting up, handling daily operations, and funding expansion. Without strict control over these funds, the company bleeds out. The system designed to prevent this failure is financial management. It manages the finance function itself. To manage that function, a business executes 4 core activities. They must plan, organize, direct, and control the flow of money. These activities apply specifically to the procurement of funds, the internal utilization of that capital, and the distribution of earnings to owners. But how do these abstract management concepts translate into the day-to-day survival of a company? To see the impact of financial management, we start with the assets. It dictates the size and composition of a company's fixed assets. When leadership makes a capital decision to invest 100 crore rupees into new facilities, they are setting the physical foundation of the business. This cube represents that fixed capital. Once that money is spent, it is locked into place, creating a rigid base for the company. A business also needs more liquid resources, which brings us to the second area of impact, determining the amount of current assets. Current assets represent the fluid side of the business: cash on hand, inventory waiting to be sold, and accounts receivable. As seen here, inventory is a major component of this operational pool. Financial management dictates exactly how much capital is tied up in these movable day-to-day reserves. These first 2 points represent the entire asset side of a company. Financial management determines what a company physically owns. Now we look at how the company pays for those assets. The third area of impact involves determining the balance of long-term versus short-term funds. This choice creates a direct tension between liquidity and profitability. The manager must look at these contrasting trajectories and decide how much cash to keep available for the short term versus how much to commit to long-term growth. Long-term funding leads to the fourth area of impact, establishing the debt-equity ratio. This ratio defines how much capital is borrowed as debt versus how much is raised from owners as equity. That financing choice influences the various entries in the profit and loss account. For example, relying heavily on borrowed funds triggers an immediate shift in the company's expenses. High debt leads to higher interest expenses. Those payments increase the financial burden on the company, eroding the final profit. By choosing specific liabilities, a manager sets the company's interest obligations, directly defining how much revenue actually survives as profit. After manipulating both sides of the balance sheet, what is the manager's actual endgame? A business pursues immediate survival through profit maximization, but the ultimate strategic target is wealth maximization. This visual represents that goal. Wealth maximization is the process of increasing the market price per share for the owners. To reach that point, a manager must successfully execute 3 overarching decisions. These are the big 3: investment decisions, financing decisions, and dividend decisions. Mastering the 5 points of importance we explored earlier is the only way to execute the big 3 decisions and build true shareholder wealth. Remember the 5 areas impacted by financial management: fixed asset size, current asset amounts, the mix of long and short-term funds, the debt-equity ratio, and the items in the profit and loss account. If this breakdown helped you, like, share, and subscribe to the ACE Archive.